Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And we're back. Feel free to give us a call, 216-901-0945, 216-901-0945. And as the guy said, this is Bill Bullington. Bullington Capital Management here every Saturday morning from 11 to noon. And I think, it's simulcast on 955thefish.com. Or actually, I take it back at the podcast on 955thefish.com. So if you heard something and you wanted to go back and re-listen to it, you can pick it up there. If you didn't get to hear it but you wanted to, you can go back and get it there. You can also get it on iTunes. So just look up the Bullington Capital Report. Anyway, I've got a computer who's frozen up right now. That's awfully hard to talk about things you'd like to talk about when your computer's not working. But I remember we've got a seminar coming up. As soon as my computer unfreezes, I'll tell you what the date is. I didn't memorize it yet. Oh, here we go. And this is going to be a big one. This is estimating the impact of a financial crisis on your investments. We're going to kind of take a look at what potentially could happen to the various types of portfolios out there, stocks and bonds, when the market goes down a lot. We'll take a look at what happened 2007 through 2009, which categories held up the best, what would have been the best strategy for the fastest recoveries. Not that I think that one is coming, because I really don't, and we're going to talk about that a little bit later on today's show. You never see them actually coming like that. And if you did, and people, if you did see that coming, it would be really easy to make a lot of money on it, because there are things that you can do. If you know for sure that the market's going down, there are things that you can do to make an enormous amount of money on that. In fact, like the Bitcoin type money. So if somebody really knew that was going to happen, they would be really, really, really rich. Like really rich. And if you think you know how or when the market's going to go down, call me, because I know what to do to get us both really, really rich. Yeah, but you've got to be right. And that's the problem. You have to be right. So, and actually, you know what? I think at the seminar, I'll go through that. There's some things you can do that would make you really rich if you knew exactly what the market was going to do. Okay? And it'll take me 5 minutes. 5 minutes to cover that. So we'll cover that at the workshop too. Just as long as somebody reminds me to cover that. You have to remind me to cover that. The research I do now won't really stick with me. The only research I need is the pricing, by the way. The technique is pretty simple. The technique is super simple. And like I said, if you got it, if you got that technique down, and man, you can make some money. In fact, but given the fact that there aren't a whole bunch of billionaires walking around, that's got to tell you how difficult that is to get that exactly right, because you have to know what's going to happen, and you have to have the timing down. You have to know when it's going to happen. And I know an awful lot of people have opinions on that. And by the way, if I can show you how to do that, how you can actually prepare for that decline, and then if it doesn't come, you won't lose a lot of money. So I can show you that too. It's not that hard. You wonder why everybody's not doing this. Well, some of them are. A lot of people do this. A lot of hedge funds do this. They try to prepare for a decline, or if they think the market's going to go up a lot, they try to prepare for it ahead of time. They use these techniques, and the ones that hit it actually make a lot of money. And I can tell you that they're few and far between, and there's a large element of luck involved. And when they're not right, they generally don't lose a lot of money. But you see, they lose a little bit of money, and they haven't made any money during that time period. That's why that's so difficult. And there are products out there that are being sold where people are doing that. They're actually planning, well, they're actually protecting their portfolio, and they're betting on the upside. They're investing so that when markets go up, they participate to some level, but when they go down, they're insulated. And the cost of doing that, incidentally, is enormous. And, people call it all kinds of different things. One of the names you hear a lot is portfolio insurance. Well, the insurance premiums are really high. So if you pay a really high premium and then what you expect to happen doesn't happen, you just spend a lot of money. And that's why I'm not a big fan of that. That's why it's not real popular, because you can go for an extremely long time period and lose money, small amounts, but you're losing them consistently over time. And I don't know that we're not going to go into that in great detail at that workshop. By the way, it's Thursday, March 8th. You can go to my website to sign up, bullingtoncapital.com. Thursday, March 8th. It's a corporate college over on the east side of Cleveland. The right off of 271. A lot of nice shopping around there, by the way. The 6:30. We're going to start at 6:30. I don't know. It says to 9. That's just an estimate. I generally talk for about an hour. About this time, I'm going to talk for about 50 minutes. Take a 10-minute break, and then we'll come back in and just have conversation. People are asking questions, and I really like that part too. A lot of I typically will have. Well, not typically. I've actually been forgetting to do this. My apologies, but I'll have a stock to talk about that I think stands to do very well over the next few years. That's kind of the more traditional method of selecting stocks, where you're looking for companies that are extremely profitable. You plan on hanging on to them for a long time. In fact, if they go down, you're going to add to it. You're not going to sell it, which is the total opposite of another technique that I use. And I like to use them both. The other one is looking at stocks that are going up right now, putting a sell order in if it drops to a certain level. It's kind of like a retail store owner. If something is not selling as well as you thought, maybe lower the price on it, try to expedite the movement of that product. Same way with the stock. If it goes down, we're just going to take a small loss and move on because it's not going up anymore. And then as it starts to go up, as the ones that do continue to go up, we're going to follow those up with orders. I'm actually working on a small course for that because I like it. It's fun. It does remind me of being a retail store owner, or actually a Major League Baseball designated hitter. It's very similar, and you'll know what I mean if you decided to get to that workshop. And like I said, I started writing the outline for an online course for that, because that's something that today almost everybody can do. But I'm not going to talk a lot about that in the future. I'm going to kind of put that on the back burner for a little while because the course isn't ready yet. So I'll when it is ready, I'll start to talk more about it. In the meantime, what I really wanted to talk about today in particular is, people keep talking about they think the market's going to crash. And you've always got people saying that, by the way. I mean, it doesn't matter what the market's doing. At the time, it could be crashing, and they're still saying it's going to crash. And when it's going up, you've got people that are just constantly saying that. And a lot of people feel that way. I understand. Market spends almost as much time going down as it does going up. So, a lot of the times they're right. But again, they've got to be exactly right. And they have to do certain things, and they've got to get the timing right in order to make money with that, but which is very, very, very difficult to do. The better thing to do is kind of take a look around, look at the things that have just gone up the most. Those typically are not the ones you want to be throwing your money into, which is a very common mistake. Right now, everybody wants to buy large cap growth. They don't even know that that's what they want to buy. They just know that that's the category that's gone up the most, and the mutual funds that are investing that way, or the exchange-traded funds that are investing that way, have done the best, and that's where they want to put their money. Well, there's a slight problem with that, and the problem is those things will do the best until they don't. And when they've outperformed as much as they have, it's much riskier to be adding to that investment now. It's okay to hold it. But you don't want to be putting the vast majority of your money in there. That's too risky. You don't want to be putting the vast majority of your money in there. I think I have about 10% of the stock portfolios that I manage, or the ETF portfolios that I manage. 10% is in that category. And I'm glad they're there because it's done very well. And when I go on an annual basis to rebalance that, if it's more than 10%, I'm going to cut it back to 10%. I'm going to take some money out of that. That's that particular technique. And incidentally, I have the largest percentage of my personal money invested that way, or actually of my retirement account. There's a retirement account that I'm running, and most of the money's invested that way in the same ETFs that I recommend to a lot of my clients. And that one category has done extremely well. Extremely well. In fact, all the categories last year, which is kind of unusual, all the stock categories were positive. All of them were. The best category, which was large cap growth, large cap means large companies. Companies like Google, Facebook, huge companies. They were up, the index that they're a part of was up right around 30% or so, a little over 30%. Little over 30%. Now, those companies are selling for $33 per share for every dollar's worth of earnings they have. Think about that. You're paying $33 for every dollar's worth of earnings. And a dollar equals what percent of 33? It's right around 3%. Okay? Right around 3%. So, in other words, if you were the owner of all those companies and you got to keep the profits, last year your return's 3%. That's still slightly higher than a 10-year treasury. 10-year treasury right now is around 2.5, 2.6, somewhere around there, in the middle twos. So when people say it's going to crash, it's overpriced, it's overvalued. Well, not relative to the 10-year treasury, which anybody that's got an advanced degree in finance knows you would use in some of the calculations to discount future cash flows. And if you don't know what that means, don't worry about it. It's not a big deal. The bottom line is those stocks are still not grossly overpriced based on that model, and that model is used by an awful lot of fund managers. So they're not, are they higher than they should be? Yeah, long-term average is somewhere between 16 and 20. It's at 33. Long-term average, 16 to 20, it's at 33. Is that a crash? No, that's not a crash. And by the way, that's just one segment of the stock market. If you break them up into 9 segments, you've got value-oriented, those companies that we believe are selling at lower valuations. You got growth-oriented, those have higher valuations, higher growth rates. That's the one we were just talking about. Then you've got the blend of the two. So you got the blend of the value and the growth. They call that core most of the time. And you've got 3 layers. You have large companies, mid-sized companies, and small companies. They just divide them up in their categories that way. So you have a total of 9. And out of those 9 categories, the highest last year was the large company growth companies, was up 31%. That's huge. I mean, that is a huge year. Okay. Now, the small cap value, the smaller companies selling at values are believed to be undervalued, or at least by the definition of the fund, was only up 8.4%. Now, the typical reaction to that is, oh, well, who wants that? Well, those small companies, you're only paying you're paying around $14 for every dollar's worth of profit that those companies are generating. Now, let's assume that you're Warren Buffett and you can buy just about any company you want to buy. And let's assume you're looking at 2 companies, and one company is selling for $33 for every dollar's worth of profit. The other company is selling for $14 for every dollar's worth of profit they generate. Which one do you want? Pretty obvious, right? You want to pay the smaller amount. So that smaller amount was only up a little over 8% last year. But it's a better bargain. And that's, quite frankly, that's one of the reasons why it's a better bargain, because the other one has run up so much. It's gone up so much. A little over a year ago, the you're only paying around $20 per every dollar's worth of profit in that category because they did so well this year. You're paying $33. It's a buy low, sell high, right? But you got to know where low is, and it's buying low and selling high in the short run. By the way, is painful. You're in the wrong asset class. You're in the wrong category. Or when I don't say wrong, if you're in the one that's underperforming at the time, that's painful. But incidentally, when they switch, when those roles switch, because if you look in the long run over the past 40, 50 years, in the long run, all these categories are within 1 or 2% of each other. Think about that for a second. Think about that. In fact, we got a couple minutes until the commercial break. I want you to think about that, because there's something that you can do as an individual investor to smooth out your investment returns, to make sure that you're never last. If you had all of your money in the small cap, that would be, or strategies that were similar to that, you'd probably be a little upset. I'm sure you would be, unless you knew what I was going to tell you when we come back from the commercial break. Then you won't feel so bad, because investing can be really complicated. It can be, or it can be relatively simple. And I think 2018 was one of the years that I committed myself. Committed. I signed up for this service. I'm learning how to shoot my own video myself so that I can get it edited, put it up on the website. A lot of these concepts are not really all that complicated. It does help, I think, if you have visuals. I know it does. It helps if you have visuals. So 2018 is going to be the year for Bullington Capital when we start shooting some videos, and I'm going to try to keep them all under 90 seconds, which I think is really interesting. One of the, I read something somewhere where I think it was a 1-minute video was worth 1.8 million words. I don't know where they came up with that, but it sounds good to me. If I can shoot a 1-minute video and that means I don't have to write 1.8 million words, awesome. I don't know if that's true or not, but I do know that video is a lot more effective than radio, because you have the visuals and you have the voice and you have the inflection, and it can really help you out here. So now they hear the music. That means I have to take a real quick commercial break. This is Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And we're back. Hey, you know what? Want to call us 216-901-0945, 216-901-0945. Have any questions, comments, concerns? And we're talking a little bit about the how one particular segment, like if you take the, let me back up for a second. So if you look at U.S. stocks, Morningstar and a lot of the institutions out there, they like to break it up into 9 categories. They're small companies, large companies, and medium-sized companies. And in each one of those categories, they split them up into 3. You've got just a blend of everything in that category. And by the way, they're ranked by size. So roughly, the large companies are the largest, the medium-sized are the medium-sized companies, and smaller companies are the smaller. They have some differences, incidentally, in how they break that up. Doesn't really matter. Then they take that and they break it up into 9. So the blend is all the companies in each one of those categories. And then they have these ways of separating them based on valuation. And the more undervalued securities are considered the value stocks. The stocks that might be slightly have higher valuations and growth rates would be the growth stocks. Occasionally, a stock will actually make it into both categories, by the way, which is kind of interesting. But being what it is, you look at those 9 categories, and then people watch those categories because they do have a tendency to move differently from one another. And one of the ideas behind this whole process is to try to come up with a blend of all those asset classes or all those categories to give you a smoother result. smoother than, say, putting all the money in the top 1,000 or the top 500 companies just by size alone, because that's what the vast majority, more money is invested that way than just about any other way. The challenge with that is that it's really volatile. I mean, extremely volatile. So in an effort to try to take out some of the volatility without giving up too much in return, they've come up with these methods. Let's just take the three categories, large, medium, and small, and split them up into three. That gives us 9. And if we spread them out over those 9, then we should get better risk-adjusted returns. We should have smoother returns. And when you look at those categories within those groups, the 9, you get an idea for what is currently doing the best. And if you ever go back and track that over long periods of time, you're going to find out that they all have a tendency to have extremely similar super long-term returns. The smaller companies tend to have a slightly higher long-term return than larger ones do. Why? Because they're smaller and typically they're growing faster. And a lot of companies will show up, when Google and, a lot of companies, when Amazon first showed up, those guys were small cap companies. Microsoft, small cap company. They became a medium-sized company, and now they're super large. So companies will move up through those ranks. And I can promise you, Microsoft was growing faster when it was a $4 billion company than it does today when it's a $400 billion or more. I forget what it even is now. And I'll look that up during the next commercial break. But it was just growing faster because it was smaller and more capable. So companies will actually move through each one of those categories. And I think that's kind of interesting too. But the pensions out there that have hundreds of billions, even trillions of dollars in them, and have to manage for the general public who are one day going to be collecting from the pensions, many of them are already, they manage their money using these 9 categories, and they also have international emerging market, and they are splitting them into they're creating other categories. But right now, the big macro or the major categories are the 9 U.S. categories. Then they have emerging markets and international. Those would be the other 2 categories that are extremely large. Now they're kind of separating those out too, but be that as it may. So all those categories, when you look at an extremely long time period, their returns tend to be pretty similar. That's amazing, actually, especially when you consider a lot of them are in other parts of the world. But in the short run, there's a big difference in how they're going to perform. Like I was talking about at the beginning of the show, the large company growth in 2017 was up over 30%. The small company value was only up 8.5 or 8.4. That's a huge gap. In the long run, they're almost identical in performance. In fact, the small company has an edge. The small company value has an edge over the large cap growth. If you go back far enough, it's actually outperformed it. So here's my point. If you get one of these categories, over the next 20 or 30 years, their performance is going to be fairly similar. And one of them has underperformed recently. What does that category have to do to catch up? Think about that for a second. If 2 categories are going to be relatively similar, are going to be very similar 20 years in the future, and one of them has recently underperformed, what is it going to have to do to catch up? It's going to have to go up faster, right? That's the answer. And that's kind of the idea behind diversification. You want to diversify in types of stocks that you own because it reduces or it eliminates the need to have to predict with accuracy which one is going to outperform over the next 12 months. So you no longer have to be a fortune teller. You no longer have to guess at which categories are going to outperform. And you don't have to guess at what you're going to do in the meantime. You can put a plan together. You can hold money in each and every one of those categories. At least some. As you get closer to retirement, you may want to concentrate on areas like the large value, by the way, like the dividend paying stocks. They weren't up that much last year. They were up about half of what the large growth were. And that upsets a lot of people that have a lot of money in there. Yeah, but those companies have a tendency, or at least have exhibited a tendency in the past to recover quicker from a decline. So they have had a tendency in the past 100 years or so to come back faster from a decline. And that's one of the reasons that you would put that in your portfolio. If you're worried about a big correction and you don't mind being down, but you don't want to be down for 10 years or longer, then you might want to consider overweighting or putting more money into those types of stocks. When you have an environment like the one that we're in now, it doesn't make as much money. When the market's going sideways, a lot of those stocks are paying dividends. Those dividends are still coming in. They're buying more shares every time a dividend hits the account. So the number of shares that you're buying is increasing when the market goes sideways. When the market goes down and then stops going down and starts to recover, they typically have had, at least in the past, a history of recovering quicker. Now, it's great that you know that, but now that you know that, why? Why? Just knowing what has happened in the past is okay, but if you know more, it increases your chances of being more successful. See, the reason that those types of stocks have had a tendency to recover quicker is because a stock that pays a dividend that declines in price has the experience of the dividend yield going up. If I have a $50 stock that's paying a $2.50 dividend over a year, that's 5%, right? If the stock goes down to $25, like it might have done in 2007 through 2009, they don't cut their dividend because the stock price goes down. So that dividend now is 10%. And I'm using large numbers like this and big swings in share prices just to illustrate a point. So if the stock's dividend yield now is 10%, and let's say, yeah, maybe business slowed down, maybe 2, 3, 4% or so, but it's not like it got crushed. Yeah, and now the dividend yield's 10%. Whenever the Fed takes the actions that they need to get the economy going again, which they will do, they'll always do that. It's just a matter of time. And the amount of time that it takes for them to do that actually controls how severe the correction is. And the good thing about these is we've gotten better over time. Our Fed has learned more. They have more information now. They've got more experience. And we actually recovered fairly quickly from that one. That was a big one. That was a big scare. I got to tell you, I was really worried. Now, the thing that worried me was the banks kept saying, well, this is it. This is all we did. We can start fixing this now. And then the next quarter they come out, oh, sorry, actually, we did a lot more. That's what kept worrying me. But I knew eventually they would get to the bottom, whenever they decided to fess up for everything that had gone on. Anyway, long story short, whenever the Fed steps in, companies that have big secure dividend yields tend to bounce back pretty quickly because that dividend's really attractive, at those levels. And it's that simple. That's why dividend-paying stocks have a tendency to rebound from a severe correction quicker than other types of stocks. It's because of the yield. And I remember talking to a client I had a long time ago. Oh, man, I can't believe it's over 20 years now. Holy cow. I'm getting old. And he was much older. He was in his mid-80s, and he had been investing ever since he got home from World War II. And he was a cook in the Army, and he was in the desert in North Africa, served in the field in combat. He was one of those guys that had to follow around and follow the troops around. And by the way, the cooks back then, they had to know how to shoot a gun too. So tough guy. And we were talking about it in, after World War II, he was telling me that it was very difficult to buy stocks that didn't pay dividends. Almost nobody wanted to buy them. And I thought about that. And I had to talk to other people in the industry that had been in it for a very long time before they'd retired. That's a nice thing about my business, by the way. It's not very physical, and it's actually very mental. So your mind stays real active. So you can do this for a very long time. It's one of the benefits of doing what I do for a living. Anyway, so I thought that was interesting, and several people I had talked to. And then I went back and I did some research and looked it up, and I was going, well, holy cow. If you wanted to sell a stock to the general public in the 40s and 50s, you'd better be paying a dividend. Otherwise, they probably weren't buying it. And I thought, how interesting is that? Because nobody had really talked about that too much. And you used to hear these guys going around talking about how the dividend made up 50 to 60% of the return of the S&P 500. If that were true today, the long-term return on the S&P 500 would only be about 3%. Because the dividend yield's like right around 160 or so, 1.6. So 3% would be and if that's going to be half the return, and you're looking at a return of slightly over 3%. However, things have changed. Companies don't have to pay dividends anymore to attract investors. In fact, there are over 100 in the S&P 500 that don't pay any dividend at all. So things change over time. They do change. In fact, they've changed in the past 5 years. That's another thing we'll talk about at the workshop, how they've changed. There are funds, and it's a good change, incidentally. This change I really like. It's made some things a lot more challenging, but it's made other things a lot easier. It's a lot easier to get exposure to those 9 categories we were talking about earlier in the show, the small, medium, and large U.S. companies, both the value and the growth and the blend. That's a total of 9, 3 categories times 3 types of funds. It's 9. It's a lot easier to get exposure there today than it ever has been. And you also have international emerging market there. There've got to be a couple thousand funds just in those categories when you add mutual funds and ETFs together. So there's a wider array of products, a larger number of funds to invest in to be able to get diversified. It wasn't that easy in the past. It wasn't that easy to do. Now it's a lot simpler. The challenge is reading all those prospectuses. That's a challenge. There's typically a description in each one, and it'll give you a shortcut. And if somebody reminds me at the seminar, I'll bring it up. It gives you a shortcut. There's you don't have to read the entire prospectus on each fund. They tell you, read the prospectus carefully. Yeah, well, that's because lawyers wrote that thing. There are areas on a prospectus that you really do need to pay attention to, and most of it you don't need to pay that much attention to. So we can get a much higher level of diversification. I think that's a great thing. You can track your investments and all of your finances easier today than you've ever been able to. Bullington Capital, we offer this service that you can go into. You can set up your accounts. Incidentally, if any of you are using it, it's funny, I've been talking about it. I've only had a handful of requests. We've sent some emails out on it. A lot of people are just unaware that this tool is available, but you can hook up all your investment accounts, your savings accounts, your checking accounts, your credit card accounts, and it monitors all your spending for you. You're the only one that can see it, unless you go in and change the settings to allow somebody else to see it. But we'll talk about all that stuff when we come back. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned.
Sounds of the city pounding in my brain while another day goes down the drain. Yeah.
Hey, and we're back. So we're up to that portion of the seminar, the radio show, where I typically talk about individual stocks, and I'm going to talk about it a little bit today. If you have any questions, comments, feel free to go to my website, and it's bullingtoncapital.com. There's a contact us page there. Feel free to fill that out. We'll be glad to get back with you and try to talk about whatever it is you would like to talk about. And don't worry about salespeople calling. I'm the only one there. The other staff is in. It's all administration because there's a lot of paperwork in what we do. There's a lot of effort in a lot of things in what we do, and we need other people in there to be doing that. So we're not going to call you and try to bother you. We just don't have time. So if you like to call us, that's great. The number is 330-664-0700, 330-664-0700. And, one of the things I'd like to leave or at least close that segment with is that stocks are really not grossly overpriced. And depending on where you're looking in the market, some of them are downright undervalued. So there's still time. If you've missed this, or you feel like you've missed this, don't worry about it. There's still time. And even the stocks that have gone up the most are not grossly overpriced. Most of them are not. So this thing could run, market could run a lot farther. And I really like that. I think it's a good time to be investing. I think that you really need to understand the amount of risk you're taking in your portfolio. You've got to custom tailor that portfolio to for your own risk tolerance. And that is so hard to do. When people are out there thinking about what they're going to do, you got these questionnaires that nobody knows how to answer. And they have to ask them anyway because they have to have some sort of a process. That's part of the SEC and the FINRA and Department of Labor rules now. You've got to have some sort of a process to try to estimate what somebody's risk tolerance is. That is not an easy thing to do. I feel bad for everybody in the industry. So I've got one that I think is it probably chases business away because I talk about how far markets can go down. I talk about how far markets can go down. And when you've seen indexes like the S&P 500, actually almost all the indexes in 2007 through 2009, they're all down right around 50% or so from the peak to the trough. Some of them were down a little bit more than that. Emerging markets, I think, was down 70. So I look at that and I go, okay, if that has the potential to happen, and I don't want to be down 50%, the solution is just don't put 100% of your money in stocks. That's the solution. Trying to jump in and jump out is not the solution. Trying to figure out exactly when the right time to be in and out is not the way to do it. If it were that easy, there would be a whole bunch of billionaires walking around. Okay, so that is incredibly difficult, if not impossible to do except by luck. So I'm going to take a real quick phone call right now. If you'd like to call us, 440-941-0945. And I'm going to go to Jeremy right now. Jeremy, you have a question?
Yeah, good morning, Bill.
Hey.
See, I wanted to get your thoughts on General Electric. It's pretty beaten down stock right now, and do you think it might be a good long-term play as far as a comeback goes?
Well, here's the thing. GE is actually in one of the portfolios that I manage, and it's also in a lot of the ETFs that are out there. So if it were a part of that portfolio, I'm going to hold it, but you have to understand it is a small part, very small. It's not going to make or break me if that thing, if GE ends up splitting up into a bunch of little companies and going away. In fact, that might even make money if they did that. But when you're asking about a company like GE, here's the problem. And everybody thinks that people like me are avoiding the question and they just want us to give them a simple answer. Well, life doesn't work that way. It's not that easy. GE has a ton of different divisions that have nothing to do with each other. What does a jet engine have to do with finance? What does a jet engine have to do with an MRI? GE is one of the bigger MRI manufacturers in the world. Did you know that?
I did not know that.
Yep. GE is also one of the bigger manufacturers of train engines. Did you know that?
I did know that.
Okay. So they also make a lot of light bulbs. and they were actually getting out of that business, and then they decided to get back in it when the LED thing came along. But anyway, so they've got all these businesses that have very little to do with each other. And any one of those businesses at any point in time can cause them to lose a lot of money because each one of those businesses is in an industry where change is really fast. I mean, they're all based on technologies. And technology is constantly changing. It's not like Hershey's, where chocolate, they might put a little bit more cocoa butter in it this quarter because the price dropped down. It's still chocolate. The GE is tough. That is hard. And a lot of the businesses that they're in are extremely difficult. They're extremely difficult. So when I look at something like that, that's one of the reasons. If it's in one of my models that has a predetermined dollar amount that limits the risk to that stock, then I'll go ahead and buy it in that model. If it's in one of the funds that I'm in, okay, that fund is being run very similarly by using a model. And we'll own it because that's the part of the discipline that you do. But if it's not a part of that, then personally, I don't know. I mean, the dividend yield, the trailing dividend yield is 5.2%, but they've talked about cutting that or even eliminating it for a while. So it's that's tough. That is just such a hard stock. That's like, actually the question is like, I don't know when one of the Browns going to make it back into the playoffs. I don't know, and their professional team, GE is a professional company. It's been a great company for an awful lot of people. So the past, since 1998 when it peaked, it hasn't done well at all. And it's just one of those things where it's so hard to know the answer to it that your guess is probably as good as mine, quite frankly.
Mm-hmm. Yeah, I mean, they cut the dividend in half. It's still yielding just under 3% at these prices. And they have new leadership in place, so I'm just wondering, if there could be some potential significant upside over the next 1 to 2 years.
Well, their revenue, trailing 12 months, was $122 billion. The market value of the stock right now is $140 billion, so it's slightly over 1 times revenue. And the profit margins on the company are really going to determine if they can get back to profit margin. In the last quarter, it was a minus 30%. So they took a lot of write-downs for some reason. Looks like over the past 12 months, they lost $5.7 billion. So that's tough, man. All those businesses are so hard to predict for that I really don't wager guesses on stuff like that because it's too hard. I look for ones that I think are easy. And right now I don't see a lot of easy ones popping up, but occasionally it'll happen. If the market drops 10 or 15%, there will be a bunch of easy ones around. But I wish
it seems like GE is the only stock on sale right now.
No, there are a lot of them. I see it. I see it all the time. I look at the scans. There are a lot of stocks that are selling beneath where they should be. That's one of the reasons I'm pretty optimistic, because a lot of these stocks got hit pretty hard last couple of years, when small and mid cap were just getting kiboshed, and the only thing that was going up were the large cap stocks. So a lot of them have still not fully recovered, and that's what makes me optimistic, because they're at good valuations, and now their share prices are starting to appreciate again. So should be a couple. The market should, all other things being equal, something surprising happens. You never know. But right now, valuations are very reasonable. In some areas, they're actually really low. So that's a good thing. When you look at when you look at the 9 basic categories that make up the U.S. stock market, and all their valuations are high, I'm going to hold a lot of cash.
Right.
But we're not there yet.
Got it. Well, I appreciate your insights, Bill. Thanks.
Oh, thanks for calling. Yep. Have a good day. And I'm going to go right to Brian. Brian, you have a question?
Hey, Bill. How's it going?
Hey, how you doing?
Not bad, thanks. Hey, I was just wondering if you ran the scan, or if anything good came up on the scan.
Yeah, I actually run them every day, and it's interesting. I think I was just talking to last caller about this kind of stuff. There are lots of stocks that do come up on scans. Here's one of the things that I'm a little bit hesitant to do. Oftentimes, if somebody hears me now, and I've had this happen a few times over the last couple of years, where I've talked about a stock and somebody just bought it and held it. And you and I both know in that particular style of investing that is not a good thing to do.
How about that would be GoPro probably. No, I'm just kidding.
Yeah, absolutely. Or any other stock.
Maybe I'll call your Maybe I'll call your office Monday. Maybe we can talk.
Yeah, that would be good. Any other stock though? I mean, that's one of the things. The reason I was talking about the other stuff earlier in the show. There have been a lot of companies that had a little bit of momentum and turned around and went back a lot lower than they were when I bought them. And some of them, I look back at some of that stuff and go, wow, it's a good thing I sold that thing. But anyway, Brian.
Yeah, I ended up selling 3 yesterday, so just, hit my stop. So
cool.
All right, thanks a lot, Bill.
All right, have a good day. Yep. Been listening to Bill Bullington right here on 1420 The Answer every Saturday morning from 11 to noon. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.